The NASDAQ composite, you're seeing that flat, but just barely to the downside by about 0.1%. The S&P 500 down by about 0.1% as well right now, 5.8 points lower here to start things off. This comes after we saw a record close for the Dow Jones Industrial Average yesterday on Wednesday, and the S&P 500, its second highest record close there. So we'll continue to watch how these major averages move throughout the rest of today's trading activity. There were a few big themes in play, and joining us now to help us break those down as the markets are opening mostly lower at the start of the day is Michelle Schneider, good friend of the show and partner and managing director of trading research and education over at Market Gauge. Michelle, good to speak with you this morning. We're seeing solid Q3 earnings across major industries, and the S&P 500 less than 1% from its all-time highs. So what risks to the market are you keeping an eye on right now?
Well, I'd say two, really. One would be, of course, the inflation narrative, which is now on the lips of everyone, including the word stagflation. It's a real risk. And lately, what we saw was something that is really key to watch, which is silver starting to outperform gold. So regardless of what your position is on both of the metals, the idea of the fact that silver starts to outperform gold is very inflationary in and of itself. So that's something to keep an eye on, because if that trend continues, and especially since we've already seen such record high prices, let's say in food, for example, that could eventually wreak havoc in the market, because right now we know the Fed still remains relatively accommodative, or at least hands off, and if that should change, there's a risk. And the other would be really the overall demand based on the inflationary factors like the labor market and the supply chain problems. And of course, the fact that right now we're having sort of more of a hoarding mentality. So if we don't see a robust demand going into the holiday season, that could also put the brakes on it. But otherwise, everything right now has a risk-on indicator, and so there's really no fear yet.
I feel like you and I have been talking about this risk, though, of stagflation for months now. And of course, as the inflationary concerns have raged on here and not been as transitory as the Fed had once called them, and Treasury Secretary Janet Yellen as well had kind of echoed some of that. As of this point in time, it being stickier than perceived and the risk as well of stagflation, just walk us through the significance of what that could mean if that became a longer-term impact as well.
Well, for one, in terms of the earnings for companies, especially companies that cannot pass those higher costs on to customers, will get a very sour earnings period for the next quarter and then perhaps the quarter thereafter. Also, because of the fact that right now the Fed would be in a real pickle, because if we start to see any kind of slowdown and they raise rates, they know that that's going to wreak havoc on the market. On the other hand, they can't really afford to have that inflation get out of control. So that's another thing that's really going to be interesting to see what happens going forward. And the other really big impact is, unfortunately, on people's pocket, because they're not going to be able to afford some of the cyclical type of stuff that they've been buying through the years, like particularly technology, like the new iPhone, for example. And so what will happen there, too, is that people will cut back or go into more of a hoarding mentality, which is kind of what we're seeing here already with food, in that you look around shelves nationwide, and some of them are empty, even though they're saying the supply is out there and stuck out in the water somewhere. So I think all around, if you just go back in history, it could really mean that the market could not necessarily go into a major recession, but at least at some point with the economy kind of stagnating and waiting for this to clear, which could take a couple of years, we could see a range-bound market, which would mean that a lot of people who depend on the market to continue to go up for their retirement plans or whatever will not see much gains. And at the same time, it'll hurt their pockets in terms of going out and buying anything.
We got to talk about unemployment claims as well, falling for the fourth week in a row, with last week totaling 290,000. When you think about how much this actually continues to move the trend in the right direction, holding on to a two-handle for the second consecutive week here, where more broadly are you keeping an eye on labor participation and the sectors specifically that are seeing the greatest percentage of labor force participation as well?
Well, in terms of lack of participation, the real issue has been, of course, in the transportation sector, with truckers not going back to work, and of course in the entire travel, leisure, entertainment, and dining and hotel. Those are also really having shortages. And so that's having a big impact as well. But in terms of the overall labor market, last month we also saw, right before we had the jobs report come out, we saw the jobless claims fall. We saw a surge in just sort of private sector work, and yet the numbers were still really not that great. And we have a trend, like we saw in August, of people quitting work and people not going back to work. And young people, by the way, making more money sitting home trading cryptocurrencies than they are if they go get jobs. So that's going to be, I think we'll see some people will have to get back to work, obviously. But I think we've really seen the whole workplace shift probably for a really, really long time. And that if people can stay home and make money investing, that's what they'll do.
The NASDAQ is on pace to finish the week in positive territory. The index is up over 1.5% thus far. And when you think about your outlook on the tech sector for the rest of the year, what most notably would you be keeping an eye on?
Well, I always like to look at some of the newer technology, and especially the technology that doesn't necessarily have the impact of having to pass higher costs on to customers. So we've been in Zscaler, for example, and Upwork, and we're still looking at some of the ones that have been beat up, but we like going forward, like Palantir and Teladoc. I probably would stay away from the big growth companies at this point because I'm not sure how much more upside they have. But those have potential, and of course, a lot will depend on what happens with the overall market. And like I said, really keep your eye on the transportation sector because I think that's key to really be able to measure demand.
The composite must have heard us summoning it into the chat here as it just turned positive here on the morning as well. So we'll see exactly where some of this hyper waffling nets us out at as we go on throughout the rest of the day. We got to talk about financials and energy very briefly as well. Top performing sectors in the past 4 weeks. What do you make of these industries as we move toward higher inflation as well?
Well, the financial sector can actually still prosper even in inflationary times, particularly if interest rates go up. And we're obviously seeing a big boon from the earnings that happened in all of the bank stocks. American Express, interestingly enough, is at new all-time highs in reports on Friday. So right now I'm still very friendly to the financial sector, and that's why we're seeing the market not collapse at this point. And you can see inflation and the market run hand in hand for a bit. At some point that may separate. In terms of the energy sector, there's no denying right now that there is a shortage in terms of how much is being pumped out to meet the oil demand. Something like 700,000 barrels a day worldwide are in shortage. That's why we're seeing the gas prices and the oil prices go up. Could they have a dip based on some profit taking? Yes. Could they have a dip based on prices? Yes. We saw that in China last night. All the commodities kind of crashed along with Evergrande. But for the most part, right now, the trend is still up, and we haven't even hit the winter, and they're predicting a very cold one, particularly in the Northeast.
Right. Michelle Schneider, always a pleasure to get some of your insights and the context that we should be approaching today's trading activity with, partner and managing director of trading research and education